Taxpayers beware. 2025 budget traps that will drain your wallet. Welcome back to Canada Chronicles. Canadians are being told about tax relief in 2025, but the truth is more complicated. Hidden in the budget are quiet traps like bracket creep, provincial shifts, and strict Canada Revenue Agency penalties that could drain your wallet when you least expect it. And while Ottawa points to savings, many families may still feel squeezed once the fine print kicks in. That's why you'll want to stay tuned until the very end. We'll break down the realities of the income cliff, capital gains timing, and the 2026 squeeze, a critical piece of the story that could decide whether you save or lose thousands. So don't miss a moment. Make sure to hit subscribe, turn on notifications, and stay with us as we unpack everything you need to know. Let's get started. Canada's 2025 budget has been framed as offering tax relief and affordability measures. But behind the headlines, subtle shifts are putting extra pressure on ordinary Canadians. Instead of clear tax hikes, the strain shows up in bracket mechanics, phased-in changes, provincial tweaks, and strict enforcement of penalties. For households already stretched thin by high rents, rising grocery costs, and persistent inflation, these hidden traps mean that even when the government claims to be giving you relief, you could still end up paying more. At the federal level, Ottawa reduced the lowest income tax rate from 15% to 14%, effective July 1st, 2025. Since this cut only applies halfway through the year, the effective rate for 2025 averages out to about 14.5%. A worker earning $40,000 may notice some savings, but not nearly as much as if the new rate had applied all year. From 2026 onward, the full 14% will be in place, but for now the savings are partial. Another big factor is the capital gains inclusion rate. For 2025, it remains at 50%. Starting January 1st, 2026, it will rise to two-thirds for gains above $250,000 per individual each year. For corporations and most trusts, the higher rate will apply to all gains. That means timing is critical. Selling a second home, a stock portfolio, or a business stake in 2025 is far cheaper than waiting. A $500,000 gain would mean $250,000 is taxable this year compared to $333,000 next year. At a 40% marginal rate, that difference equals about $33,000 in extra taxes. There's also the digital services tax. Collection stopped on June 30th, 2025, and legislation is moving forward to repeal it. Refunds with interest are expected once repeal becomes law. For digital advertisers, e-commerce platforms, and online businesses, this brings relief from uncertainty. But GST and HST compliance continues to weigh heavily, especially on small entrepreneurs who face strict deadlines and penalties. The provinces are reshaping budgets as well. In Alberta, a new 8% income tax bracket applies to the first $60,000, replacing the old 10% rate. Workers saw payroll adjustments mid-year, but the full effect won't be felt until 2026. In British Columbia, the provincial carbon tax was eliminated on April 1st, 2025, coinciding with the federal government ending its fuel charge. Families expected relief, but some municipalities may adjust property taxes, utility charges, or local fees to make up for lost revenue. The result is that many households saw little change in their overall costs. This shows a common pattern. When one tax goes down, another fee often rises. Cities across Canada continue to increase property taxes, land transfer charges, and service levies. A family buying a $600,000 home may face thousands in unexpected fees, tightening budgets even further. Bracket creep adds another layer of financial strain. While federal tax brackets are indexed for inflation, provincial systems often lag behind. A small raise can push a worker into a higher bracket, while benefits like the Canada Child Benefit and GST credits phase out quickly once income crosses certain thresholds. Families expecting to gain may actually lose ground, leaving them worse off despite higher earnings. The Canada Revenue Agency continues to enforce penalties that catch many taxpayers by surprise. Late filers face a penalty of 5% of the balance owing plus 1% per month, up to 12 months. Repeat failures are penalized even more. Interest compounds daily, and freelancers or gig workers often face the steepest bills when installments are missed. The CRA does not accept ignorance as an excuse. Credits and deductions also pose risks. The Canada Revenue Agency has tightened rules on what qualifies as legitimate expenses for home office claims, vehicle costs, and professional write-offs. While there haven't been sweeping cutbacks, reassessments are frequent. Taxpayers who miscalculate, even accidentally, can end up with hefty bills that include interest and penalties. Immigration policy links to tax planning in less obvious ways. Ottawa's 2025 to 2027 plan reduces temporary resident levels to ease housing and service pressures. But the ripple effects are real. Colleges that depended on international tuition may raise domestic fees or push for more subsidies, which provinces often cover by raising taxes or reducing services. At the same time, industries like agriculture, construction, healthcare, and food processing rely heavily on temporary foreign workers and permanent residents. When the labor supply tightens, costs increase, and those costs eventually flow down to consumers. These may not be called taxes, but households still feel the pinch. Altogether, these factors create a quiet squeeze. Federal tax cuts make headlines, but bracket creep, reduced benefits, rising local charges, and CRA enforcement can leave families worse off. Small business owners and investors are especially vulnerable if they fail to plan carefully. Thanks for staying with us this far. We appreciate your time and hope you're finding this information valuable. Income cliff, capital gains timing, and the 2026 squeeze. One of the most dangerous realities in 2025 is the income cliff. A worker earning $60,000 who accepts overtime to push their income to $65,000 might expect to be ahead by $5,000. But once provincial taxes, benefit clawbacks, and credit losses are factored in, the actual gain may be just a few $100s or nothing at all. Many Canadians are discovering that working harder doesn't always leave them further ahead. Capital gains timing is another key factor. Selling property or investments in 2025 means paying tax at the 50% inclusion rate. Waiting until 2026 exposes those same gains to the higher two-thirds rate above $250,000. For families selling rental properties, cottages, or large portfolios, that timing difference can mean saving or losing tens of thousands. The 2026 squeeze is coming. The government has given plenty of warning, but many Canadians are not preparing. When tax bills rise in 2026, it won't be because of sudden surprises. It will be because people failed to act when they had the chance. How to protect yourself in 2025. 1. Check your payroll withholding. Ottawa's mid-year tax cut and Alberta's new bracket created payroll changes. If your withholding is wrong, you could face a surprise bill. 2. Map your income. If a bonus or raise pushes you over a benefit threshold, RRSP contributions can offset the impact. 3. Plan capital gains wisely. Selling in 2025 may save thousands compared to waiting until 2026. Couples should consider joint ownership to maximize thresholds. 4. Monitor provincial and municipal changes. In Alberta, confirm you're benefiting from the new bracket. In British Columbia, track local adjustments after the carbon tax repeal. In Ontario and Quebec, watch how provincial credits interact with federal ones. 5. Avoid CRA penalties. File and pay on time. If cash is tight, set up installments to avoid daily interest. 6. Entrepreneurs and incorporated professionals should balance salary and dividends carefully, while staying on top of GST, HST, and local fees. 7. Prepare early for 2026. Review your finances now. The capital gains hike and new provincial measures are coming, and waiting until tax season will be too late. So here's the bottom line. Canada's 2025 budget may look like relief, but the hidden traps tell a very different story. From bracket creep to CRA penalties, from capital gains timing to local levies, the true cost is buried in the details. Unless you prepare now, your wallet could take a bigger hit than you ever expected. That's why acting early is the smartest move Canadians can make in 2025. Thanks for watching and staying informed with Canada Chronicles. If you found this breakdown helpful, don't forget to subscribe, turn on notifications, and share this video so more Canadians understand what's happening behind the headlines. We'll keep bringing you the latest updates that affect your money, your future, and your life in Canada. Stay prepared, and we'll see you in the next video.